Hi everyone, good morning. Thanks for joining us for our morning call. For today, we have a few macro and sector outlook. We're starting off with the REITs monthly, then a few highlights of the recent FOMC meeting, and as well as the usual Singapore weekly. So without further ado, I'll hand you over to Natalie for the REITs monthly.
Hi, good morning, everyone. So I'll be talking about the Singapore REITs monthly. Next slide. So just to start things off, this is how the REITs have been performing against the real estate developer index as well as the STI. So the REIT index, which is in blue, is currently still underperforming both the real estate developer index as well as the STI. In the first month-on-month, the REIT index returned a negative 1.3 returns, and of course year to date they're down by about 3.6%. Next slide, please. So in this graph, we see that on the left hand side, the light blue line is the is the yield spread. So every time we see the yield spread narrowing or going down, then we can see a corresponding rally in the REITs. So there's an inverse relationship between the FTSE REIT index as well as the yield curve, which has been seen in the past few years. So this time round, we can see that the blue line is very much very close to the bottom to zero, meaning it's very narrow. But the REITs haven't yet to rally. So of course, so what we think is that when the banks eventually lower interest rates, that's when you will start to see the REITs actually pick up. Okay. On the graph on the right hand side shows the interest rate movements. So we can see just in the last week, we know that the Fed raised the Fed rate by 75 basis points, but also we can see that both the short rates, which are the 3-month SOR, as well as the long rates, the 10-year bond, Singapore bond yield, has also picked up significantly. Next slide, please. So in terms of valuations, this is what it looks like. The price to NAV of 1.03 times is currently at the 10-year historical average, which is at the red line in the graph on the left-hand side. If you look at the forward dividend yield spread, so we know that the REITs have pulled back slightly year to date, down by about 3.6%, and that of course has resulted in a slightly better dividend yield of about 5.6%, which is at the negative 0.7 standard deviation level, so slightly lower than the average in history. Next slide, please. In terms of sensitivity analysis, we did a sensitivity analysis to see the impact of a 150 basis points increase in interest rates and what impact that will have on DPU. So in the light blue line here is the hedged impact. As we know, most of the REITs, they do employ interest rate hedging. So on the hedged impact, we'll see a DPU decline of about 3.3% to 13%. But if you look at an unhedged basis, meaning assuming that the REITs do not employ any interest rate hedge, then the impact will be greater. We will see DPUs move between 11.8% to 23%. And the graph on the right-hand side shows the 150 basis points increase in interest rate impact on DPU yield. So of course, I think on average, the DPU yield for the REITs under our coverage is about 6%. Next slide, please. Okay, in terms of our sector preferences, so we have rotated our sector preferences from retail and industrial to office and hospitality. This is in view of the geopolitical uncertainties and the tapering growth forecast that may translate into more conservative business and consumer sentiment if the US is unable to engineer a soft landing, in which case the retail and industrial REITs would be most at risk. So we prefer the office sector due to the improving occupancy levels amid lower supply, as well as the hospitality sector on the resumption on international travel. So basically, we think that there's a bit of pent-up demand for both leisure um, as well as corporate demand. Okay, for the retail, for the on the graph on the left hand side, we see that the April 2022's retail sales value is 4.5% above pre-pandemic levels. And in terms of the F&B service value, that has narrowed to the narrowest amongst the whole pandemic. Within the whole pandemic, is down by about 3.3% compared to pre-pandemic levels. So of course, as these are the April numbers. So of course, as more people return to the office, as Singapore welcomes more visitors, international tourists, we can expect the F&B services value to tick up even more. Next slide, please. So as mentioned, we are overweight on the hospitality sector. So, and we expect pent-up demand for both corporate and leisure travel to support the average daily rates. In the graph, the red line shows us the visitor arrivals. So that has actually increased significantly. And currently, for the month of May, the international tourist arrivals is currently at about 28% of pre-pandemic levels. So we still have some way to go. But of course, this number hasn't yet, according to Singapore Tourism Board, there are about 66 more international events that are expected to happen in the rest of 2022. So that, of course, will bring more visitors to our shores, not to mention some of the major entertainment events, such as the Singapore Grand Prix that will happen in October. In terms of hotel RevPAR, revenue per available room, that is currently at 73.5% of pre-pandemic levels. Okay. So I think that's all for me. The next slide will show you the REITs under our coverage. Okay. All right, okay, that's all for me. I'll now hand it over the time to Sean.
Thanks, Natalie. So I'll be going through the meeting highlights that happened on the 15th of June, last Wednesday. So next slide, please. Yep, thanks. So last Wednesday, the Federal Reserve has raised the federal fund rate by 75 basis points to 1.5% to 1.75%. This is 25 basis points higher than the guidance given in the previous meeting of a 50 basis point, as the consumer price index inflation accelerated to a 40-year high of 8.6% in May, surpassing the previous high of 8.5% set in March. The Federal Reserve has decisively pivoted its policy stance to a more aggressive approach to address the rising inflation. The last time that the Federal Reserve has raised the rates by 75 basis points was back in November 1994. Next, if you look at the chart on the left, this is the dot plot graph, which provides guidance to the number of hikes that the Federal Reserve expects. So for 2022, the mean projection of the appropriate level of the federal fund rate is about 3.4% at the end of this year. This is 1.5% point higher than the projected in March. In 2023, the median projection is expected to rise further to 3.8% and decline back down to 3.4% in 2024. The Fed has reiterated that they are continuing the process of significantly reducing the size of their balance sheet. Thus, in terms of forward guidance, the Fed has mentioned that it would likely to be either a 50 or a 75 basis point increase during the next meeting in July. Next, for the guidance for GDP, the Fed has reduced the expectation for the US economy to grow by 1.7% this year. This is lower than their previous meeting, which they expect to be 2.8%, as the Russia-Ukraine conflict has created more difficulties such as fluctuation and spike in commodity prices. In 2023, the Fed expects it to remain at 1.7% and 1.9% in 2024. With regards to the unemployment rate, the rate in 2022 stands at 3.7%, 3.9% in 2023, and 4.1% in 2024. According to Chairman Powell, Though the unemployment rate is ticking higher to 4.1% in 2024, it is still at a historically low level. And lastly, for core inflation, it's expected to be 4.3%, and this is higher than the projection of 4.1% previously. This was attributed to the surge in prices of crude oil and other commodities that resulted from Russia's invasion from Ukraine, and COVID-related lockdowns in China are likely to exacerbate supply chain disruptions, which creates additional upward pressure on inflation. So overall in this meeting, the Fed stance were more hawkish as they are focused on bringing inflation back down to their 2% goal, quoting, we will need to be nimble in responding to incoming data and evolving outlook. Hence, going forward, we can expect a tighter monetary policy if the Fed deems necessary. That's all for the FOMC meeting. And with that, I'd like to hand over the time to Paul to discuss about the Singapore Weekly. Thanks.
Thanks, Sean. Next slide. In terms of some of the macro news for Singapore last week, some of the more important ones, we had some export numbers out of Singapore. So it remains strong, especially for electronics. It remains robust, about 13% growth for electronics. Just to give you some flavor, 2017, 2019, Singapore exports hardly grew every year. So even though it's a bit, so a 12% growth in exports for Singapore is still a very robust number. In terms of the private residential sales, the new launch sales, in May we got a big bounce, 52%. But if you look at year to date, it's still down 32%. But it's a strong recovery, at least from the April's 48% decline. There were some very good numbers coming out from airlines or tourism. If you look at SIA passengers carried, this is not just Singapore, this is their total passengers carried. In May was 1.3. So this is a huge jump. It's like 11 times jump year on year. And it's even quite surprisingly, it's quite even close to their pre-pandemic May 19, about 30%, one third still below pre-pandemic levels. Another good number for Singapore was our employment. It remains very robust. Employment is up 47,000. It was across the board. More critical is services is also up 17,000. If you the fourth quarter 21 is the total number 54,000. The number of unemployed, the number of vacancies to unemployed is I think a 30-year high at 2.4 times. That means there's 2.4 times vacancies compared to every one person looking for a job. In terms of the commentary like we mentioned by Sean Powell, so you should expect 75 or 50 in July. So right now the futures is pricing 3.6% interest Fed funds rate by end of December. The Fed is also forecasting not far 3.4. So what this implies is that you are going to get at least another 200 basis points move in by the Fed. So that so right now the lower bound, because the Fed rates is there's an upper bound, lower bound. Usually we look at the lower bound. So right now it's 1.5. So you should expect interest rates to at least in another way double by the end of this year. So this is an aggressive move. Initially, the Fed was only looking at 2%. So our initial thesis was that we thought the Fed will move to neutral rate. So neutral is, there's no hard number to it. Neutral basically means it's an interest rate level which won't be like constraining the economy or expanding. So it's a very flattish, not tightening or loosening monetary policy. We thought that was 2.5, 2.25, but right now it seems to be almost around 3% based on their own forecast by year end. So the Fed will likely move to around 3 before they kind of slow down or their interest rate hikes. In terms of the US, the retail sales remain very strong. It's about 11%. Pre-pandemic was about maybe 2-3%. Of course, there's a lot of discussion whether is this a good number since there's inflation, but even if you strip it out, you're still looking at about 3% real retail sales growth. So the US consumer remains healthy despite the rising inflation. So in terms of a tactical view, the market is really in a pickle here. It's a very technical word here, but because we are getting this double-barreled or demand destruction, so we're getting higher interest rates which will hurt demand. and we also are getting inflation, which is also going to hurt demand. So until we get some clarity how how much more the Fed going to raise rates, I think the market will be very subdued, if not coming sideways at the very best. And the problem is that there is a low probability of any silver bullet. That means any silver bullet for inflation in near term. So what are these so-called silver bullets? Of course, if there's a resolution to Ukraine conflict, that will of course revise downwards inflation expectations. So that's unlikely to happen. Number two, the other silver bullet is if the US were to cut China tariffs, again, this is also politically unlikely to happen. So the third silver bullet is if Biden goes to US and somehow, even if they could, like in the middle of next month, Saudi Arabia could raise production. That is a possibility, but could be only just a temporary relief. So these are the three ways to cap down inflation, or inflation expectations, but this is unlikely to happen for now. So one way to hedge it out is that whenever the economy is slowing, investors tend to move into treasuries, which is US government bonds. But even that is also falling. So one way to hedge it out is probably to just go into gold, which would benefit from the flow. I mean, although interest rates, there is no interest rates on gold, but gold is like a safe haven to just write out this selling across all asset classes. So it's so it could benefit from the flows going into this asset class. So just one last word. I mean, I don't cover US, but it's pretty clear. And the problem is that the US analyst earnings forecast haven't really been revised downwards sharply enough in our own view, because if you look at oil price up 45, then you have US dollar up and interest rates up. So all this basically means it's a big headwind for US corporate earnings. But we don't really see the US consensus. This is not a Singapore thing, but this is more for US corporate earnings. The big news for this week will be the semi-annual Congress by Powell, so he'll probably have some more commentary on his intentions. On Wednesday, we will have a webinar by UniAsia, so I think it will be interesting because you're seeing dry bulk demand remains very robust and there's hardly any new supply. But so those who are interested can dial in on the 22nd. Next slide. Okay, this is just an illustration of the exports. So you can see from Singapore, although it's sliding down, it's weakening, but it still remains very strong, especially the red line, the electronics, which is, I guess, less volatile. Because the Nodex includes chemical and pharmaceutical, which you get very wild swings every month. So although it's slowing down, but it's still relatively robust compared to the prior years. In Taiwan, if you look at the exports in Korea and Taiwan, although it's sliding, but it's still very strong. If you strip out the 2017 jump that you see here, you're looking at like a decade high growth or strong growth in exports. So electronic exports remain strong, although it should be coming off its peak. So what we think is that you could probably see that swing away from goods consumption into services. Next slide. So if you look at if you look at SIA numbers or airline transportation, you look on the left, you can see this really sharp spike in passengers for at least SIA. And surprisingly, again, like we mentioned, it's almost close to 70, it's just 30% off pre-pandemic levels. So it's a very sharp rebound. A bit surprised how they managed to cope with it too. If you look on the right, this is up to only March. The US airline passengers is up 40%. I think you can expect even stronger as they hit the summer months. But up to March, you can also see in the US that the passenger traffic is really robust. And this year on year is up 40%. Next slide. In terms of Singapore, you can see that the employment numbers on the left, you can see that the last 2 quarters, 55,000, 47,000 is exceptionally strong. If you look at the last decade, these are numbers you don't see for, I don't know, the last decade, those are the recovery. But even then, if you look at the losses we had, like 113,000, we are still 94,000 below the 2019 peak in the total number of jobs in Singapore. Because I think most of it is probably like in construction and so forth, mainly the foreign labor. The table on the right if you look at the number, it's a bit hard to see, but the yellow orange line basically refers to vacancy. That means vacancies to unemployed, the number of vacancies to every one person that's not working. So the last time it was so high was, I think, 1997 or something of that sort. And if you look at, more important is also the orange line, which is PMAT. So the vacancies for professionals, managerial, executives, and technical staff is also exceptionally record numbers, because this is as far as they have the kind of records, the kind of data. And this is, of course, important for companies like HRNet, which also does a lot of permanent and also flexible hiring. So this is a positive chart for them. Next slide. This is just my last slide. This is if you look at this is the interest rates for the Fed, which is the red line, and the blue line is the interest rates in Singapore. So what you could see now is, as we highlighted earlier, the Fed is only halfway through in terms of raising rates. So this red line is only halfway through. So you could see it reaching a decade high, which is higher than the 2019 level. And this could also mean that the interest rates in Singapore and also the net interest margins in Singapore for the banks could be at decade highs. Again, why we say may is because there's always these things like competition and so forth. Whether how much of it translates to NIMs there's never a one-to-one, but I think all the banks have guided very strong NIMs. So this rise in the blue chart, at least for Singapore interest rates, will be a positive for the banks. Okay, I think we're a bit quiet for this week, so we can move on to Q&A. Thanks.
Hi, good morning. I'll take some questions. First question is, if I understand your chart correctly, among the REITs, ART is most affected by the interest rate hike. Am I correct? In a way, you can say that, although it's not because that they have a very low hedge ratio, neither is it because they have a very high interest rate cost. Okay, so first of all, their hedge ratio is about 74%, and this compares to the rest of the REITs. In fact, FCT's hedge ratio is even lower than ART's at 56%. And the rest of the REITs have slightly higher interest rate hedges compared to ART. So one of the reasons why it seems that ART is more impacted is because their share price hasn't yet recovered back to the pre-pandemic level. So on the earnings front, it is lower compared to what they actually have been earning. But yet, when it comes to increase in interest rates, that impact will be felt across all the loans that, or rather all the loans that have not been fixed. Yeah. Okay. So that's the main reason why it appears as if ARTs is more susceptible to or more impacted by interest rate increases, when actually it's because the share price hasn't yet, the earnings hasn't yet recovered back to pre-pandemic levels. Okay. The next question that I see here is regarding Manulife Prime as well as Keppel Oak and Digital Core. Can you share a view of what is happening? And will I be making any adjustments to my TP? And also the third question is it a good time to accumulate any or all of the 4 stocks? So of course, these 4 stocks, they are focused, or rather their assets are located in primarily in the US. For the first 3, Manulife, Prime, as well as Keppel Pacific Oak, these 3 are office REITs. And I think if what is happening in the US, of course, apart from the higher interest rate, is that in terms of physical occupancy at the offices, it still remains relatively low, about 30% physical occupancy, meaning the people who are actually coming back to the office. Another thing is that, especially for the likes of Prime and Keppel Pacific Group, which do have more tech tenants in their tenant list, or rather, while that was initially something that was a good thing for the REITs, as the tech tenants were the ones that were actually providing better rental reversions. This time around, if you look at the news, there has been the tech sector is undergoing a bit of pressure, and we have heard and seen that some of the tech companies are actually even cutting their manpower or cutting their headcount. Yeah, so I guess that is one more reason for nervousness with regard to these three names. However, of course, the ability for the employers to get the workers back into the office, that might actually shift, the power might actually shift back to the employers. Of course, if let's say unemployment numbers start to creep up again, yeah, and then probably the employers have more power in terms of getting the workers back to the office. Yeah. Okay. As for digital core, I think the reason for their share price weakness is because of their hedge ratio. So a significant part, actually I think about 50% of their loans are actually unhedged. So that means that they will see a very significant increase in terms of their borrowing costs when the interest rates move, which they have actually moved quite strongly, just in this last year alone. In this year to date, yeah. Okay, so in terms of whether or not I will be adjusting my target price, possibly we can adjust our DPU lower to factor in a higher interest rate cost. Yeah, that will of course mean that the target price would be reduced. Yeah. Is it a good time to acquire any four of these stocks? I would say that it is. I would say that I think the US market generally seems to be a bit more volatile, and if we look forward, we are still expecting a bit more, a few more interest rate hikes, and I think that might not be fully, it might be largely priced in, but not fully. So I think that there might still be a bit of share price downside in the near term before the central banks start to lower interest rates and the REITs will rally. So I think probably can hold off for a while more, yeah, to wait and see how things shape up. Yeah. Okay. I see some more questions. Oh, sorry, for Daiwa's ex-dividend date, let me get back to you. Okay, I think most of the questions are now for Paul. Oh, so there's a question asking about MNEC. So for MNEC, currently the shares have been suspended, and or rather, sorry, since the 8th of June, that was when it was the last trading day for MNEC units, and of course, by now you will have known what's your cleanup dividends, as well as between the 15th to 29th of June, that is your election period, to decide whether you would, what kind of scheme consideration you prefer, 100% cash, 100% units, or a combination of units and cash. So for unit holders of MNEC, this is your election period that will run from 15 June to 29 June. And if you fail to make a selection, then the default payment mode will be 100% cash. Yeah. Okay. Okay, let Paul take some of the questions first.
Yeah, thanks, Natalie. When you were not around, we also had an email on MNET, but just to brief everyone, there was also always this question why the cash offer price was lower than the share price. So that's because of the cleanup dividends, like Natalie mentioned. So cleanup dividends is like dividends up to May. It's not like a full quarter's dividends, but whatever dividends that shareholders were maybe entitled, maybe for 2 months and so forth. So we had some questions on that. I just wanted to clarify that's what we mean by cleanup dividends for those who may not realize. So actually, it was, I guess, quite nice of them to pay out everything, even up to the very last day, whatever dividend, whatever earnings that they have accumulated, you just pay it out. The other thing is, okay, so the question for me is, Paul, can you comment on the recent news, Singtel redevelopment of Comcentre, and secondly, potential Airtel stake? So for my own view is that I think Singtel is also trying to pursue what a lot of the Temasek link companies are doing, trying to just restructure and try and monetize some of these assets that's in their balance sheet. I mean, like a better word, these are like lazy assets that are not doing much on the balance sheet. So for the redevelopment, the Comcentre that is happening, so they're going to redevelop it into a property, mixed integrated development. So that's going to be a positive. So like they're selling it and also renting it back. The other thing is the Airtel stake, which, because Singtel is always a sum of parts story, and Airtel is probably 1/3 of the target price. But if you don't monetize anything of if you don't monetize, then most of it is more like paper valuations. So although we think they would want to sell a little bit just to monetize and see that these are not just paper valuations, that there is ability to monetize some of this. But I don't think it will be much, but it will be also send a positive message for the market, and also could also raise their dividends. But for us, we still like Singtel because, I mean, in view of this environment where growth may be a bit slower, why we like Singtel is at least the visibility for some earnings growth is still there. You get it in 3 ways. I think, sorry if those who already know about this, but the roaming revenue returning as borders reopening, so Singapore and Australia will benefit. Their emerging markets associates, Thailand, Philippines, and so forth, will just benefit from overall reopening and economic conditions improving in emerging markets. So that will be another driver, and of course the third one is just party itself, the momentum in party and the decline in competition. So in view of this environment where growth might be a bit slower, then at least there's better visibility in growth for a large cap with Singtel. That's our own view. And also, of course, there's also means there's also upside in dividends for them. Morning, Paul, I appreciate your opinion on the direction of STI for the rest of the year. Okay, for STI, we think the third quarter could still be a bit very sideways. I think the overhang for the market is, again, just how slow global growth will be. I think it won't be so bad for Singapore because we got tourism coming back, and we are reopening, and that still remains one driver to grow. The only issue is for banks, which I think Glenn will mention, is that there's now global growth slowing. There's always going to be this always this thing going to prop up about the worry of a recession and also slowing growth. So I think until then, I think we'll probably move sideways for third quarter until we get some better clarity in the fourth quarter. Either inflation starting to recede, I won't think it would collapse, but at least recede, and also maybe the Fed showing some leeway that they may not wish to tighten as much as possible if growth slows. Until then, I think it's going to be hard for the market to kind of rally hard from here, because there's this, like we highlighted earlier, there's this double barrel push towards lower growth by interest rates and inflation. Okay, can you recommend strategy for FANGs? I think maybe Ambrish can help. Let me take on this last one before I move back to the rest. High Paul, current Fed funds rate 1.5, while 10-year Singapore government bonds is 2.7. If the Fed fund reaches 3.5 by end of 22, what is the expected 10-year? Okay, so the 10-year Singapore government securities will likely closely link more to the 10-year treasuries. So my guess, this is purely a guess, it probably could hit 3%. Because right now, or maybe 3.4, maybe the mid threes is a possibility, because it all depends on how far the US Treasury is going to move. Yeah, and the US Treasuries could move quite high, quite strongly, since there's already QT coming up. There's quantitative tightening. So with all this, we could see the 10-year Treasuries moving to the, I don't know, high threes. If that's the situation, then the Singapore government bond yields could move to the mid threes. And I guess what you're trying to allude to is also it will put a bit of valuation pressure on some of the Singapore REITs. So if your REIT is giving you 4% yield and the government bond yield is giving you 3.5 or 3.6, then that begs the question. I mean, like how much should we be paying for Singapore REITs if the government bond yields go to 3.5? Don't ask me the question. I can ask Natalie. Yeah. Okay. Is the rest ready? Can we take on the rest?
Yeah. So let me just take on the question on the recommended strategy for FANGAM stocks. So we still remain overweight on FANGAM, and our preferred stock picks are Alphabet, Google, and Microsoft. The rising corporate demand for Google's high-margin cloud services should continue to push revenue growth forward. And for Microsoft, we believe that the strong demand for its higher-end licenses like E5, it has a strong outlook going forward, mainly because of the rising cybersecurity concerns. And secondly, the Azure, which is due to the digital transformation and cloud migration trends, is likely to benefit. And also with the offices reopening, it's the demand for official commercial growth from small and medium-sized businesses is going to improve going ahead. Yep, that's all from me.
Glenn, you want to talk about the banks?
Yeah. So I think it's a question on to please comment on the three local banks. Let me turn on my camera. Okay, never mind. I can't turn on my camera. Okay. For the local banks, for the outlook is quite similar. I mean, the names, rising rates will definitely increase their NIMs. However, there's some worry, definitely, with the banks facing a lower price performance. This is mainly over fears that borrowers would face financial stress as well as overall slower growth. So while, as I mentioned earlier, the rate hikes are positive for banks in terms of increasing their net interest margins as well as their net interest incomes, there are fears that with these increasing rates, the borrowing rates would increase as well. So these will lead to a general slowdown as their borrowers are now more cautious in taking up the loans. So there's a possibility of an increase in bad debts as the existing borrowers do not have enough time to adjust to their higher interest payments. However, nonetheless, the banks have actually not indicated that their bad debts will increase as the economies they're in is mainly in Singapore and ASEAN are just starting to reopen and they are recovering from the pandemic lockdowns. So they have also provisioned enough for any future sort of like bad debts or increase in their NPLs. They've also sort of forecasted that they are guided for their outlook is quite similar. So their loans growth is all mainly mid to high single digit. So they have not shifted from that after their first quarter announcement. And also credit costs are stable. So most of them is from 12 to about 25 basis points. Yeah, so I think that's all I have for the banks. I'll hand it over to the rest. Thanks.
Yeah, if you look at let's say DBS NPL ratio, so right now it's 1.3. Even at the worst of times, if you're talking about global financial crisis, SARS is probably about 3. So even if you talk about US recession, it might maybe edge up to maybe 2. So right now, we don't think you are in a big provisioning cycle right now. Most of it seems to be more developed market and more slower global growth rather than what we had in the Singapore banks in 2016, where a lot of our local 2016 was the oil and gas issue. Then 2000 was about pandemic. So right now, at least from our lens, we don't see any country-specific systemic issues or a spike in NPLs. So that is unique to Singapore, because there could be just total global growth slowing down. Yeah, so, I mean, this is our general commentary for now. Let me just run through a few before I move on to Natalie. Hi, Paul, what ways can we invest to benefit from the shift from goods demand to services? So for me at least, probably Nat can mention more. I think hospitality is probably one of the ways, especially like escort, because what we think right now is there probably another 2-3 more waves of better growth in hospitality. So right now what we're seeing is just the first wave, which is just leisure travel coming back. I mean, now everyone's going for holidays, so you get this first wave. The second wave we think will come from business travel. And the final wave is, I think we can only hope and guess, like we highlighted before, will be the China wave. So that's why we think hospitality, there's a lot of room to grow for hospitality. And there's a bit of, you get this pent-up demand. So the rates, the RevPARs, which is the hotel room rates and occupancy could even surpass pre-pandemic, because there's this big, huge pent-up demand. Yeah, of course, the timing, how big it is, depends on when China opens up, which I mean, nobody really truly knows. Let me just move on. Paul, can you share on SIA increasing capacity towards pre-pandemic level? So your views on when one should start accumulating given this. Yeah, for SIA, although the volume is up, but it doesn't mean profitability is up. You still got competition, you still have oil price. I guess for us, we are a bit more conservative. If you want to play volumes only, I mean, which is what's happening now, purely volumes, then you're talking about sets. Maybe talking about SIA engineering. Yeah, but the tricky thing for SIA is, like you highlighted, the MCB. So the real, if you adjust for the MCB, the real book value of SIA is probably like 3 something, I think 360 something. On paper now it's like $7, but that's because of the MCB kind of not including the shares. So if we are a bit, for us now we are a bit more fundamental, not so trading oriented, but for us, that's why if you're playing on volume recovery, then that would be the SIA and SIA engineering and sets. Because for SIA, you still worry, like I said, oil price, competition and so forth. But I don't think competition is an issue now, since there's not enough capacity, I guess. Nat, you want to take on some? What's your views on sets? Yeah, maybe Terence, you want to add more if you have any.
Yeah, Paul, I'll take the question on sets. So for sets, the recovery outlook is still strong for them. One thing we like about sets, we don't cover sets, is that they have a monopoly on the gateway services. So their fortunes are tied to the travel recovery in the Singapore sector. But in the near term, for sets, we are a little bit more bearish because they are trying to hire ahead for the future. So this hiring costs and the training of these workers will take about 6 months to 9 months, depending on the role and the function. So in the near term, their expenses is expected to outpace revenue growth, and so that there could this will have a dampening effect on their earnings. Otherwise, the longer term outlook for sets is still positive at this moment. Yeah, that's all for me. I'll hand it back to the rest of my team.
Hi, okay, I'll take the question. Hi, if the retail sector is slightly negatively impacted by the recession concerns, less spending, would it negatively impact hospitality REITs more, as leisure travel is discretionary spending and the strong revenge leisure travel now may not be sustainable, and the corporate travel may not recover as much as pre-COVID as corporate shift to online meeting? So I just take it part by part. In terms of demand for corporate travel being lower than pre-COVID levels due to shifting towards online meeting, we think that is likely. Meaning to say that corporates will incorporate virtual meetings as part of their corporates will use virtual meetings more compared to pre-pandemic times. Apart from that, but that doesn't mean that we think that the corporates won't travel. We think that they still will travel because of needing to maintain the rapport and the face-to-face kind of interaction. But perhaps corporate travel or business travel will be more targeted, and it will be more impactful in the sense where they will try to put more meetings together rather than be very loose about it. So instead of maybe flying out for 1 or 2 days, they might do it for a week and a half, and they will try to see more clients or meet more people within that period of time. Yeah, so that's how we think that corporate travel will evolve. It will be more of similar, it will be more of a hybrid, and that could possibly mean that perhaps the corporates are traveling less frequently, but they might stay for a longer time rather than do multiple back and forths. Sorry, hold on. Let me see the question. It scrolled away. Okay. With regard to the leisure travel, I think earlier, I hope we heard what Paul said about the leisure travel. And it's not just leisure travel, but there are more than one catalyst, or rather more than one demand drivers for tourism. Yeah, meaning to say that as he mentioned, the leisure travel and the corporate travel come back. Yeah, and also of course the reopening of China eventually. Yeah. And I think the pent-up demand that we are seeing for the hospitality sector, be it leisure or corporate, that is something that will help, because over the past 2 years, probably the budget that the corporates have set aside for this travel has virtually not been touched for the past two and a half years. So I would say that it's like high time for them to actually go back and start to re-establish the rapport that was absent initially. And in terms of even for consumer spending, the desire to travel versus the desire to spend at the shopping malls, I think that will be the differentiating factor between the retail REITs as well as the hospitality REITs, or rather the retail and hospitality sectors, meaning to say that the desire to spend will be more skewed towards the experiential, more skewed towards the travel, instead of your regular spending or shopping at the malls. Yeah, so I think that is why we think that the pent-up demand factor is the wild card here, which will continue to drive the hospitality sector. Okay. Another question, a good question. Hi Natalie, if recession is of concern going forward, wouldn't office REITs be negatively impacted as corporates hold back expansion plans and even retrenchment? Hence, industrial REITs will be more back in favor again, as it is more resilient, like the recession we experienced in 2020. Okay, so for the Singapore office market, what we know is that yes, there was some supply delays due to the pandemic, and the supply has been pushed into the later years of 2023-24. That being said, we are not at the same. What we are experiencing right now, 2022 going to 2023, is different from back then in 2019 going to 2022. So back then, what we saw was that perhaps some of the office users, they had excessive amounts of space. Maybe the banks had more space than they actually needed. The legal firms had more space than they actually needed. So what we saw was then a cutting of space, downsizing, right sizing, and return of space. So that we saw occupancies for the office sector dip during the pandemic years, and consequently we also saw the rents dip for the office sector. And now where we are, we actually some of the REIT managers have actually shared with us that it is sort of reversing. In the meantime, the Singapore REITs, they do hold grade A CBD assets, meaning to say that when rents become cheap, long-term office users or office users who think that they're going to be in the market for some time will then take the opportunity to rent out these good quality assets at a discount price. So there will be a flight to quality. And that, of course, has been helping to steadily fill the occupancies. And not to mention, some companies may have overdone it a little bit on the right sizing. Some of the REIT managers have shared that office users who previously returned space are now coming back to ask for more space. Some of them being the banks that they have downsized and they come back and they ask for more space. So I would say that 2019, 2020, and versus where we are right now is a completely different situation. Back then, yes, there was probably more excessive use of space or excessive rental of space beyond what the company needs. But right now, I would say that in terms of space usage is more efficient for companies. And therefore, perhaps the need to downsize would be lower. Okay. And I think, yes, I think if recession were really to hit us, then probably what we will see is, companies going bankrupt or companies winding up and giving back space. I think that will be under a very not extreme, but that will be under a recessionary kind of scenario. But for the Singapore market, we think that in the meantime, apart from a more healthy or more efficient use of space, efficient ratio of space usage by the companies, Singapore market is also benefiting from some of the migration of Hong Kong offices into Singapore. So that will of course also help to take up some of the vacancies in the market. And as I mentioned, most of the supply will come in 2023, 2024, and the vacancy levels for Grade A offices have already trickled down. Yeah. I hope that answers the question. Okay, another question here is, hi, would the expected higher interest rate going forward negatively impact the property developers, as there are reports that property prices have started to moderate / drop in overseas markets? Hence, would it also negatively impact the property demand in Singapore? Thanks. Okay, so I think that definitely will, that for home buyers that have over leveraged themselves, I think definitely those are the property owners that will start to feel the crunch when the interest rates start to ratchet upwards. That being said, most of the government has tried to clamp down on speculative buying. A lot of the buying that we've been seeing in the recent years, be it during the pandemic, these are all mostly for residential purposes, meaning to live rather than as an investment. So not to mention the kind of LTVs and the coverage ratios, mortgage servicing ratios, those have been they have been calibrated such that to prevent home buyers from actually over leveraging themselves. So I think while that, yes, there definitely will be some people who are starting to feel the pinch, but we do expect that the interest rate cycle might not. We do expect the fallout from it to be more muted and not so severe. Yeah, whether or not the property prices will drop, we think that has more to do with at where they are at the present levels, which is currently we are at record high levels, and the growth might moderate or might correct slightly, but we don't think that yeah. So I think that's separate from the interest rate issue. Yeah. Okay. Okay, so for the question on Daiwa Logistics Trust, I do believe that the reason why the share price has taken a hit is because of the weakening of the Japanese yen. Yeah. In terms of dividend date, I'm still trying to locate when is the actual dividend the dividend X date. So let me get back to you on that. Okay. That's all for me for now. I'll pass back the time. Oh, hold on. I see some questions on on Mapletree. Okay, I'll come back to you on the Mapletree questions.
Yeah, thanks. Yeah, just to follow up on the developers and the higher interest rates, do note that when you apply for a housing loan under the TDSR rule, there's an implied 3.5% interest rates. I don't think mortgage rates have hit that yet, if I'm not mistaken, but the TDSR already kind of assumed they will stress out your application at 3.5% interest rate. So there is some buffer there. I'm not saying it will placate anyone, but I mean the biggest risk is if they lose a job. But I think there is some interest rate assumption already pegged in the TDSR. Let's move on to the next one. Just curious question, why the SIBOR was higher than the Fed funds rate before previous hiking, but remain generally lower now? Yeah. Okay, when we use that chart, it might be a little bit misleading because we're using 3-month SIBOR, which is 3-month money, but Fed funds rate is overnight. So Fed funds rate is like overnight rate when banks lend to each other. So if you take a 3-month treasury, you probably have a closer link. So yeah, that's why there's a bit of an anomaly, because you're not really comparing apples to apples. But again, any difference is also could be expectations of currency and so forth. Okay. Okay, this one's a long question. Looking at the recent crypto seem to be weak links in the market. Could you explain, should crypto be trigger for crashing the market? How much impact would be on the regular REITs, basic market value? How could the general exposure? Okay, I'm just speaking just on the Singapore market. The fallout will be quite limited. Okay, firstly, those who bought crypto, usually the young, they probably don't really care about SGX stocks. I mean, you can just ask anyone who has crypto whether they actually own any Singapore stocks. My bet is they probably own none. If not, most of it, they'll either buy US stocks or they'll just buy crypto. But that's number one. But having said that, it doesn't mean you won't feel any fallout. I mean, if they're losing money, they want sorry, the fallout will mainly be on the US side and so forth. So we don't think there's a direct impact, or maybe indirectly. The third thing is that on the reverse, before the, I mean, just as a side note, before the recent collapse, we were looking at you could see companies like Hatton Land, or even OIO, doing crypto mining and crypto so forth. So the angle there was that there was a lot of wealthy crypto investors. I'm not sure now, but at least there were a lot of wealthy crypto investors, and this was one way to attract them into the Singapore market. I mean, that was just a plan, but I don't think that's going to happen right now. But anyway, the impact from crypto sell-off directly on Singapore market, I don't think there'll be any. Yeah. Because the bias we think, I think we guess totally different. Any views on Raffles? So for Raffles, we think this year because we think last year 2021 they probably over-earned a bit because they over-earned from vaccination, over-earned from testing. So earnings might be a bit softer, but medium term, I think Raffles is an interesting stock to own because there could be two big. Of course, we all know the healthcare thesis. Everyone's getting older, like me. Everyone getting older, getting sicker. We always need to eat drugs and so forth. So, need to consume medicine and so forth. So that structural story is there, but behind that structural story, there's also two things. The valuations for hospitals will going to remain very elevated. I think we did a slide a few weeks ago. Most of the recent, I think there was the most recent acquisition in Australia. I think Ramsay Healthcare. Of course, they are different. They're much larger, but they were acquired at about 40-50 times PE. Likewise, for another acquisition that was done here by IHH, another hospital. I totally forgot the name, but sorry, in Malaysia, that was also I think 40-50 times PE. So So Raffles Medical will get, although everyone might say it's expensive 30 times PE, but most of the M&A deals are all done at, I don't know, 30 to 50 times. So there is valuation support for this stock, even though it might seem expensive, because there's a dearth of hospitals or limited supply, at least private. And the second thing is, the big upside is how fast they turn around China. So that isn't priced into most valuations. Like even for my valuation, I only take in the EBITDA or PE of the Singapore, which is profitable. So we are virtually, maybe it's just me, maybe not such a good analyst, but most won't take in the valuations of China because we really do not know how to value, because there is no earnings. You can add in maybe some book value, but most of us don't really take in the valuations of China. So if China really turn around, that could be the optionality on the share price. But just that this year, because they over-earned last year, so the earnings, just like Q&M, I mean, it's also doing well, but just that they over-earned on COVID-19 related earnings. So you won't see the momentum this year, but maybe more in 2023. Okay, it's a long answer, man. Any view on Chinese stocks? Yeah, we don't cover. We don't cover. Probably give you a wrong answer. Probably should do the opposite. Whatever I tell you, but yeah. So sorry, we can't comment on that. Don't really know much. Paul, what's your outlook for oil and gas counters in the next 6 to 12 1 year? This is a bit tricky. It's like predicting oil price. We only think that it will stay elevated, but we're not sure if it's peaked. And the tricky thing is, we're coming to driving season, so that would be one big test for oil price and also gas. And then by next year, I think most of the European gas will be off of most of the European buying of Russian oil will be out. Yeah, so I think the next 6 to 12 months should still look positive because you got one or two of these catalysts coming up, which we're going to perk up demand or gap down supply. So 6 to 12 months still looks okay. But again, it's just a really tricky thing to kind of guess oil prices. But I guess hope that helps. What's your view on Hua Hong? Sorry, we don't really cover that. Not really sure. Okay, there's still a lot. I'll leave on to the banks thing to Glenn. Let me take on this before. What would you invest if inflation peaks? Are manufacturers seeing cost stabilize? Okay, there's a bit to differentiate because the market knows inflation is going to peak. So even if inflation peak, the market may not rally because they might just peak and plateau at the very high levels and still be above the Fed's target of 2%. So having said that, again, regretfully, the only place that we really see benefiting all this is really the banks. I don't keep saying that, although they not really perform because the whole overall market is big. But that was one area, and also, like we said earlier, hospitality, the reopening trade is the other thing. Yeah, are manufacturing seeing costs stabilize? I think in the way they are, most of the costs, I'm talking about electronic manufacturers, most of the cost comes from supply chain, from workers. And if the Chinese ones were facing a lot of, when the RMB was strong, they were hurt quite badly, the margins got hit, but right now it's the reverse. So we do think that there is some stability coming up, and the supply chain, we look at some broad indicators, it is improving a little bit. I wouldn't say it's like gapping down, but there is some improvement. Yeah. And most of the cost they can, for electronics, most of it, I mean not everything, but most of it they can actually pass it on. After 2 years of rising costs, most of them have been really trying to pass most of it to their customers. Yeah, but you will still face costs. You will still wages, especially. A lot of our listed SGX manufacturers are based out of Malaysia, and they're facing the higher minimum wage in Malaysia. Sorry, not a very good answer, maybe. Glenn, you want to take on some of the bank ones?
Yep. Sure. Thanks, Paul. Okay, so I think the bank, there's a few questions about the bank shares. It's all quite similar, so I'll just compile it all together. So they've been the main the bank's share prices have not been performing, so they've been dropping for the past few weeks. And the question is, why is this so? because of rising interest rates, it should actually positively impact the banks. And why is it? Why is this happening? It's counterintuitive, with the NIM expansion catalyst for the banks. So I think I mentioned a bit earlier why this is happening. Mainly with raising interest rates, what happens is that the banks would have to charge more. So this would mean the borrowing rates would increase. So there are fears that this would mean a slowdown in their loans growth. So that's why people are worried. However, I mean, if you look on the flip side, the increasing interest rates would also increase their net interest incomes and their net interest margins. So, however, I think as Paul mentioned earlier, Singapore is quite, at least for the Singaporean banks, we are quite sort of safe because most of the economies are still growing and they're sort of recovering. So the number of bad debts happening from existing borrowers, it would be minimal. And there's also a benign provisioning cycle. So the banks have all sort of guided for very low credit costs. Yeah. So I think that's the main answer, and that people are sort of putting more, I would say, more weightage on the negatives instead of the positives, which is sort of showing in the share price for the banks. Okay, I hope that answers the questions. I think I'll hand it over to the rest. Natalie, maybe.
Okay. Can I follow up on the question on Daiwa House Logistics Trust? So for Daiwa DHLT, their payment period, their dividend frequency is half yearly, and yeah, so we paid out in June and December. I mean, for the period ending June and December. That being said, it means there hasn't been any dividends that is declared yet. The upcoming dividends will be for the period ending from the time of listing, which is in November of 2021, all the way until 30th of June 2022. So then the dividends will be declared and subsequently paid. So currently no dividend declared yet. Okay. So Ronald, can you clarify what CD stands for? With regard to views on FHT, Fraser's Hospitality Trust, so I'm guessing this is in relation to the privatization or the proposed privatization by the sponsor. I think all things considered, the share price or rather the offer price of 70 cents, which gives an implied price to NAV of 1.07 times, seems like a fair offer. And because FEHT, given their smaller size, they have always been trading at a price to NAV between 0.8, 0.9. So this privatization offer of 1.07 times is already a premium above what they have historically been trading at. And I think this privatization strategy came up after the management was strategizing on how to realize value for the unit holders. And of course, some of the challenges cited by the management include the depreciation of operating currencies compared to the versus the Singapore dollar, as well as uncertainty in recovery outlook, as well as the small size and liquidity of FHT, which has sort of hindered index inclusion and flexibility in pursuing inorganic growth. Yeah. So with regard to the offer price of 30 cents, we think that is relatively fair for Fraser's Hospitality Trust. Yeah. So in short, we think that is a good offer. And we don't have any coverage of FHT. But if you look at the consensus target price for FHT, I believe that this actually 70 cents is actually above a premium to what the respective share target prices of the covering analysts. So I think that is also something to take into consideration. Yeah. Yes. Sorry. Thank you for coming back on what CD is. So CD stands for come dividend. Any announcement made on dividend recently? So for MNEC, their clean-up dividends is actually on the 10th of June. However, MCT, their clean-up dividends, in relation to this merger, is actually going to be on the 22nd of July. So currently, yes, I believe that it is trading come dividends until 22nd of July, before where the cleanup dividends will be announced. Okay.
Oh, whatever you answer, can you just click that you've done it, Natalie? So we just want to clear up.
Yeah, let me come back to you about the expected DPU of the MPAC. Over to you first.
Yeah, okay. Let's try to end this. We got probably only two more. Someone commented that there's some fanish. The voice. Sorry for that. Yeah, there's some fan noise. Okay, any updates on MM2? Yeah, we are trying to meet up with them. Maybe next week and give you a better answer. But just on the announcement, so there was a 50 over million debt that they had to repay this year relating to the cinema. So that has been refi into a 2-year exchangeable bond. So that's a positive. That's a big overhang removed. I guess the thing right now is investors just want to see the turnaround happening for MM2, be it for the cinema and for the production, for their production house. I guess that will be what investors want to see that happening. Any updates on AM? Yeah, sorry, don't really have any new updates on them. Yeah, we don't really have much coverage on it. Yeah, sorry, nothing, no updates for AM. Okay, I'll leave the rest to you, Natalie. If nothing, you can just end it.
Okay, I believe that the pro forma, the pro forma DPU for MPAC is around 9.56 cents for the full year. Yeah. This pro forma dividend is actually can be found in the PowerPoint slides that the manager has prepared. Okay, so the next question is about reinvesting the money that the unit holder will be receiving from MNEC payout between bank shares and MCT. Which would you recommend? Going for dividend, but wouldn't mind possible share price appreciation. Glenn, do you want to take this? I'll take another question.
Okay. Now I'll just jump in. Yeah. I think for bank shares, it's more of stability, sorry, as well as like a stable dividends and more about the recovery, because now the whole banks are not excluded from the dip. So you just to wait for the recovery, and the NIMs and the net interest income would sort of that's a positive stuff for the banks with the increasing interest rates. So I'm not sure about how about MCT, but yeah, that's the positive stuff for the banks.
Yeah, I guess one other way to think about it is that in 12 months time, what is your view of interest rates? So in 12-month time, interest rates you may not be rising, but it could still be at elevated levels. So if that happens, then who would be the beneficiary? We think it will be the banks, because if interest rates are high, then it may make REITs a bit less attractive. Yeah. I mean, this is assuming there's no sharp contraction in Singapore economy, which we don't think so. But if you're taking a 12-month view and try to think what's going to happen. So if rates climb up another 100 basis points or more from here and still stay at this level in 12 months out, then banks will remain the winner, compared to REITs in general. Anything else?
Another question. Someone's asking for views on MNEC, which, but MNEC has been delisted, so yeah. Not moving forward with the entity that we'll be looking at is the combination of MCT as well as MNEC, and they're calling themselves MPAC. Okay. The last question that I see here is in an increasing interest rate, high inflation, potential recession environment, would REITs be a better play than the property developers, as number one, both sectors are leveraged, number two, both sectors are holding real estate, and in the theory that there's an inflation hedge, and number three, REITs have advantage of regular dividend payouts over developers while waiting for the upturn again. Hence, would REITs be a better play in the current environment versus developers? I think overall you see that the developers are the ones that have been holding up somewhat better compared to the REITs. For REITs, I think there are several headwinds that the REITs face, especially in this environment of higher interest rate. So one of the things, of course, will be that they will be impacted. They will face DPU pressure in terms of due to the higher interest expense, as well as, of course, inflationary costs. Another thing is that, we have seen the REIT share prices pull back in anticipation of this higher interest rate. That, of course, affects some of the balance sheet, the strength of the balance sheet, and also the ability for them to grow inorganically, because REITs are levered. They rely on debt financing to acquire, and some of them might even need to tap the capital markets, which at the current share price might not be a very accretive, might not lead to a very accretive kind of new metrics. So I think that there are some challenges for the REITs, although they are, yes, as you pointed out, there are still dividend stocks. So in terms of if you compare between the developers and the REITs at this current juncture, or within the next 3 months, we would think that REITs will provide better upsides, given that they have actually pulled back in this period of time. And when the interest rates eventually start coming down, that might actually cause the REITs to rally. So in short, within the next 3 to 6 months will be a good time to start accumulating on the REITs, in preparation for the interest rates to come down and hopefully stabilize and lead to another bull run or acquisition spree for the REITs. Okay, so I think that's all the questions that we have. I'll hand it to Paul to address before we go.
Yeah, thanks. I know there's a lot of questions on this recession. Yeah, but do note that 2020 was one of the worst recessions that Singapore, at least on paper, that Singapore faced. Although we got a lot of government stimulus. So a lot of the stocks have been stress tested, I guess, in a way, balance sheet stress tested, and we're talking about the REITs and even the banks. So I guess something to take note of. But anyway, thanks everyone for all your time, especially all your questions. Hopefully the answers kind of help you. And hope to see you next week or even in our Uni Asia webinar on Wednesday. So thanks everyone. Take care and have a good week ahead. Thanks for your time. Bye-bye.